Keith, you still like the setup here? Ample global liquidity and stocks still attractive on a relative basis. Can you talk about that?
Sure. I mean, over the next 12 months, we still think stocks look attractive. As I mentioned, global liquidity is ample. We've had a lot of central bank easing. I will say on a short-term perspective, I think sentiment's running a little bit hot, so I would expect more of a consolidation in the weeks, and maybe even over the next few months. But we think ultimately the path of least resistance is higher. And again, we still think recession risk is relatively low. Yields are still at 1.8%, so that means about 48% of stocks in the S&P have dividend yields above that of the 10-year Treasury. And again, we think that the policy is going to remain accommodative for most of the first half of the year.
It's that policy, David, so accommodative that it's made life difficult for the bears. How do you explain the bear stance right now?
Well, the bearish stance will mostly come from either earnings disappointments because you do have a lot priced in. I mean, the bottom-up consensus is looking for 10% growth in EPS, which is going to require quite a bit of margin expansion this year. And, you know, to come and say that recession risks are low, I mean, that might have sounded good a year ago, but we're nowhere close to being priced for recession anyways. We're really priced for growth reacceleration. So if we don't get the growth reacceleration, which is now more of a hope and a forecast than necessarily a reality, or once the Fed stops goosing the system with liquidity to fight the problems in the repo market, it's a lot like what happened when the Fed started to pull back on the liquidity post-Y2K in early 2000. Just keep in mind, really, what changed since early October, you know, beyond, say, you know, phase one, which is really just about soybeans, that's when the Fed posted its memorandum that it was going to start to hoover up the Treasury bill market, re-steepen the yield curve in the process to cover up the problems in the repo market. I mean, the Fed has actually expanded its balance sheet at a faster rate in the past 4 months than it did during QE3. And the Fed's balance sheet has now a 95% correlation with the direction of the stock market. In fact, in early October, just before the Fed made the announcement, the total return in the S&P 500 was barely more than 1%. Next thing you know, 3 months later, it's up 30%. And the only thing that really changed materially was the liquidity spigots by the central bank.
You know, Keith, the market conversation was very different this time last week, really around geopolitics, the risks associated with Iran. Has that risk gone away? Is it on hold? Is it something that could potentially come back in the market and shock investors?
Yeah, it can certainly come down. One thing we mentioned is because of the run that we've had in sentiment, you're all vulnerable to the bad news. But I also want to make a comment, I think, to put things in perspective. The market's had a big run since October, but the last 2 years, the market's up about 20%, a little bit more than 20%, and earnings are up about over 20%. But you had a tale of 2 different years. 2018, we had 20% earnings growth in a market that was down as the Fed was tightening. And then last year, you basically had flat earnings and a Fed that was easing and a market that was up strong. If you look and average those things together, the market has actually moved in line with earnings. It's done it more with a lag and a lead.
Hey, David, I wonder, we talk about where the Feds, how they see all this going. We had Clarida last week. No, it was Kaplan talking about worries about the balance sheet creating imbalances. And now as we're speaking, Rosenberg, low rates may drive risk-taking like that ahead of the Great Recession. Do you have faith that the eyes are wide open over at the Fed?
Well, it's not the first time that they've been talking about financial imbalances. You know, for quite a while, I think a lot of it was more geared towards corporate credit and the fact that bond spreads in the corporate sector don't compensate investors one iota for the prospect of what the default situation is going to be in the next 12 months, even without a recessionary scenario. You know, so yeah, I think that financial imbalances are clearly a concern among some. We saw that in the minutes. And then you have a wide contingent that are more concerned about the fact that underlying inflation remains so far below target, at least as far as how the Fed measures it. So you have the two balancing off each other. It's interesting that, you know, the situation propelling the Fed to ease policy and remain so accommodative, which is their measure of low core inflation, is what's precipitating the massive financial inflation in the asset sector, broadly speaking. Now, in terms of the comment about the equity market, I'll just say this. Look at the forward multiple, which is now pressing against 19 times earnings. And I guess you can always say, well, that looks much better than what you're going to be getting in the bond market on an earnings yield comparison. but we're still pressing against really the high end of the range. When you look at price to book, you look at EV to EBITDA, price to sales ratios, we're now pressing against the peaks, or certainly the highest levels we had since the dot-com bubble in 2000. So, there's a lot priced into this market right now, growth-wise, for the coming year.
Keith, is that what you mean when you say you do expect the market to take 2 steps forward, 1 step back in 2020?
That's correct, and we've been using kind of 19p as kind of where we might see some fundamental resistance. I think the other thing is you have to look beyond just the headline index. We know that technology was the only sector to meaningfully outperform last year, up over 50%, up over 60% since December. And I think there's going to be more opportunity in some of these sectors that have kind of lagged behind over recent years, like financials, like industrials, especially if we start to see stabilization in the global economy, which is our base case scenario.